Americans love to buy stuff. That's not a cultural stereotype, it's an economic fact. On a per person basis, the US spends more on household consumption than any other developed country. And consumer spending makes up about 70% of US GDP, which is unusually high compared to other rich economies. So when people talk about the American economy, what they are really talking about is the American consumer. Growth depends on households continuing to spend. Corporate profits, employment, even the stock market depends on it. For a long time, this mostly worked because incomes were rising alongside spending. But over the last few decades, this link weakened. Spending kept going, but wages, not so much. That gap didn't disappear, it got filled. This is where credit cards come in. At first, credit cards were just a convenience to smooth out cash flows or handle emergencies. But over time, they quietly became something bigger. They made it possible for consumption to keep rising even when paychecks didn't. They turned everyday shortfalls into revolving balances. And eventually, they stopped being a backup plan and started becoming part of the baseline. Today, a huge share of consumer spending isn't coming straight out of income. It's coming out of borrowed money. And that matters, because an economy built on consumption behaves very differently when that consumption is being financed. America isn't just a consumer-driven economy, it is a credit-driven one. But that kind of lifestyle isn't cheap, and it comes with a massive price tag. An economy that leans this heavily on credit doesn't do it for free. That cost gets spread out across millions of households, month after month. As of 2025, American credit card debt sits at a record $1.35 trillion. So how did it get this bad? Because this didn't happen overnight. It didn't happen because Americans suddenly forgot how money works. Credit card debt didn't explode because people became reckless. It grew because the system slowly made borrowing the easiest and often the only way to stay afloat. To understand how we ended up with $1 trillion in revolving debt, you have to look at what changed, not in consumer behavior, but in wages, in prices, and the way credit was designed to fill the gap between them. Because the problem isn't just how much debt people have, it is what that debt is now being used for. At this point, the vast majority of American adults have at least one credit card. Many have several. And for a growing share of households, carrying a balance isn't the exception, it is the norm. About 85% of Americans have at least one credit card, and about 30% of Americans have 3 or more credit cards. But the important question isn't about how many people use credit cards, it's why they use them. Because for most people, this isn't about luxury spending. Credit cards are being increasingly used for ordinary things: groceries, gas, utilities, rent caps, medical bills, car payments. In other words, expenses that used to be covered by income or savings are now being smoothed over with revolving credit. Credit cards are uniquely good at solving short-term problems. They don't require approval for every purchase, they don't demand immediate repayment, and they only ask for a minimum payment to keep going. That's what makes them so effective and so dangerous. Because once a household starts relying on that flexibility, quitting becomes extremely difficult. And the biggest reason, as you probably know if you're watching this, is interest. Credit cards don't just let you borrow. They decide how expensive it is for you to do so. For borrowers with long credit histories and high income, that cost is already steep. But for younger Americans or anyone without an established credit profile, it is way worse. If you are young, new to credit, or had a few early mistakes, your options narrow really fast. The lowest rate cards aren't available. The generous limits aren't offered. What is available, however, are retail credit cards. Store cards are easier to get approval for because they are tied to a single merchant. They come with lower limits, and they are marketed at the exact moment someone is already spending money. But that convenience comes at a price. Retail credit cards typically carry higher interest rates, harsher penalties, and fewer protection than general purpose cards. Miss a payment, and the fees stack up really fast. Carry a balance, and the interest compounds aggressively. For younger borrowers, this often becomes their entry point into credit, not because it is optimal, but because it is accessible. And once you start there, it is hard to move up. High interest rates make balances harder to pay down. Harder to pay down balances hurt credit scores, and lower credit scores keep borrowers locked into the same expensive products. It is a feedback loop, not driven by irresponsibility, but because how credit access is structured at the bottom of the ladder. So when people talk about high interest rates as an abstract problem, they miss the point. The burden is not evenly distributed. It concentrates on the people least able to escape it. And for many younger Americans, credit cards aren't just expensive money, they are the only money available. And this is where the story shifts. Because Americans aren't hooked on credit cards just because they are expensive or unavoidable. They are hooked because for some people, credit cards actually work really well, at least on the surface. A small group of high-income, financially stable users figure out how to game the system. They pay their balances in full every month. They pay zero interest. To them, credit card feels like free money. But here's the catch. That version of the system is only available to a minority of users. People with high incomes, long credit histories, and enough cash flows to never carry a balance. Everyone else gets a very different experience. While the savvy users are winning, the majority are stuck in a system designed to keep them borrowing, paying interest, and coming back for more. And the numbers make that really clear. Credit card interest rates are hovering at around 22%, a level not seen since 1990s. At those rates, debt doesn't shrink easily, it sticks. So people try to escape. They consolidate, they take out personal loans to pay off their cards. In the first quarter of 2025 alone, personal loans originations jumped 18%. On paper, that looks kind of responsible, and temporarily, it kind of works as well. But here's the scariest part of the data. Studies shows that while people use these loans to pay off their cards, many refill the same credit cards within 18 months. It is not a ladder out of debt, it is a revolving door. Because the problem was never the card balance itself, it was the spending pressure underneath it. And that pressure is exactly what credit cards are optimized to exploit. Spending $100 in cash really hurts. You feel the cash leaving your wallet. Swiping for $100 doesn't. It feels abstract, delayed, almost imaginary. Psychologists call this the pain of paying, and credit cards are usually very good at numbing it. Banks didn't stumble into this by accident. They learned that if you reduce friction at the moment of purchase, people spend more. Then they added rewards, 1% back, 2% back, points, miles, perks. It is not a discount, it's a behavioral nudge. The reward isn't meant to make you rich, it is meant to keep you paying, and the economics only work if most people don't pay in full. There is almost a perfect example of this. When Wells Fargo partnered on the Built Card, a credit card that lets people pay rent and earn rewards, the bank assumed most people would carry balances. They didn't. Savvy users paid rent, collected points, and paid off the balance immediately. Wells Fargo lost millions of dollars, not because the credit card failed, but because the consumers didn't. That failure reveals something important. The credit card business requires most people to carry debt. Rewards are the bait, interest is the profit, and once you understand how the system actually makes money, the incentives snap into focus. Because credit cards don't just reshuffle debt between consumers and banks, they quietly move money between consumers. Which brings us to the dirty secret. The single mom paying 25% interest is not just paying her bank, she's paying for the millionaire's free flight to Dubai. That's not a metaphor. That is exactly how the system is designed. Every time someone swipes a credit card, the merchant pays an interchange fee, usually around 2 to 3% of the purchase. Those fees don't come out of the bank's profit, they get baked into prices. Groceries, clothes, everything just costs more, and everyone pays for those higher prices. Even people who use cash or debit cards. There is effectively a reverse Robin Hood effect. Money flows upward from people who cannot afford to pay interest to people who never do. Wealthier users, what banks call transactors, put everything on reward cards, pay the balance in full, and collect perks. Flights, hotels, cashbacks, lounge access, they look like they are the winners. Meanwhile, struggling users, the so-called revolvers, carry balances, pay interest, pay fees, and subsidize the entire reward ecosystem. It is a K-shaped system. One group extracts value, the other funds it. And for a long time, the industry confronted itself with the idea that this was neatly segmented, that the pain was concentrated at the bottom. But that assumption is starting to break. Delinquencies are now rising fastest amongst households earning $150,000 or more, the ones trying to maintain an upper middle class lifestyle on borrowed money. These are not people who can't manage money. They are people whose spending expectations grew faster than their incomes. Bigger mortgages, private schools, travel, lifestyle inflation disguised as success. Even the responsible users are starting to feel it, which tells you something really important. This is not a system that occasionally traps people who mess up. It is a system that quietly pushes everyone towards the edge, just at different speeds. Some people fall immediately, others take longer, but the math doesn't care. And once the group that is supposed to be winning starts wobbling, the whole model starts to look a lot less stable. Because when the people subsidizing the rewards cannot pay anymore, and the people enjoying the rewards start slipping, there is no one left to carry the system. And that is when addiction turns into withdrawal. So where does this end? Usually, this doesn't end on its own. This is a system that requires intervention. And for the American credit system, the intervention is happening right now from two very different directions. The first is coming from Washington. For the first time in years, regulators are openly talking about breaking the wheel. Proposals like a 10% cap on credit card interest rates are back on the table. On paper, this sounds like an obvious win. Lower interest rates save Americans close to $100 billion a year in interest payments. But the bank's response tells you everything you need to know about how this system actually works. They aren't arguing that the math is wrong, they are arguing that if they cannot charge 25% interest, they will simply stop lending. Industry estimates suggest that under strict rate caps, as many as 90% of cardholders could lose access to credit altogether, which exposes the contradiction at the heart of the system. Credit cards are marked as a financial lifeline, but only if they are allowed to be extremely expensive. Take the pain away, and the industry threatens to take away the product. The second intervention is coming from somewhere quieter, but just as dangerous for the system. Merchants. After a 20-year-long legal battle, Visa and MasterCard recently settled a lawsuit that fundamentally changes how credit cards are accepted. For the first time, merchants now have the power to reject specific credit cards, especially the ones with the highest fees. That means that the premium reward cards, the heavy metal ones, the luxury ones, could start getting declined. Not because the customers cannot pay, but because the store owner is tired of subsidizing their points. The perks economy is starting to hit resistance at the register. For decades, merchants were forced to accept every card, no matter how expensive it was. Now that assumption is breaking. And when both regulators and merchants start pushing back at the same time, it signals something important. The system is not collapsing anytime soon, but it is being challenged. Because an economy that runs on consumer debt only works as long as everyone plays their role. Borrowers keep borrowing, banks keep charging, and merchants keep eating the fees. Once any one of those groups steps out of the line, the math starts to wobble. So the real question is not whether this credit addiction ends. It is how it ends. Slowly, through regulation and friction, or suddenly when too many people cannot or will not keep playing along. And historically, systems built on borrowed money do not get gentle endings. They get interventions whether they want them or not.